Hello everyone, here we are in part 3, our last part of chapter 6, looking at the remaining deductions and costs that we can take on Schedule C. So, one of the important ones that will come up in preparing people's taxes, especially small business, is the idea that they get a deduction for the use of their home. This is a great benefit when it qualifies because you're taking what would normally be personal expenses and converting them into business expenses. This not only reduces your taxable income, it also reduces AGI, which, as you recall, will also affect other credits and deductions as well. So the business use of your home is deductible if it is exclusive, meaning that's the only thing you use that area. Regular, you've got to use it on a regular basis, and then for the taxpayer's trade or business. Now notice you don't have to sell things, you don't have to have customers come. It could be that this is just where you keep track of all your bills and all of your other business type items, and that you do that on a regular basis. Now, exclusive use is a little tough to prove because technically if you walked in there and did something other than business, it would disqualify it. But realistically, if you're using it almost all the time for business activities, that part of the house, it doesn't actually have to be a room. It could be a corner of a room, although it makes it a lot easier to prove and to work through if it's an individual room. Okay, and it has to be for the taxpayer's trade or business. You got to basically show you had no other place to do it. If you see customers or see clients, then it makes it really easy to say that it's a bit, the home office. But if you don't, it doesn't mean that you can't. All right. So we use a form 8829, which is basically breaks down those things that are directly part of your business and those that are indirectly part of on your business, which is your home expenses. So typically we apply a square footage calculation. We take the square footage of the home office area, which is why it makes it easier if you have 4 walls around it, and then divide that by the total of your house square footage, finished square footage, okay? And that is the percentage of your personal or home expenses that you can take as a deduction. Now, remember, direct business expenses are always 100%. So if you're using supplies, if you are paying for services, all that kinds of thing, the normal types of business expenses are still deductible. And they're always deductible first when looking at the home office. Okay? It is indirect expenses like repairs to your house, utilities on your house, insurance on your homeowner's insurance on your house, even interest or rent on your house. All of those are deductible. Your property taxes. What happens with, say, property taxes and interest, which are deductible as itemized deductions, is you deduct the part that's business on your Schedule C through the Form 8829, and that reduces AGI. The part that is left, because on your Schedule A as an itemized deduction, reduces your taxable income but not your AGI. It is because that's a from AGI deduction. But what you cannot have is more deductions for home office than income. So you have to take your regular sales or income from your business, subtract out the direct expenses, supplies and things we talked about, then look at your home office deductions other than depreciation on your house or on the part of your house that qualifies. Then depreciation, that's always last. If your expenses are deductible both ways come before the other expenses. And if you run out of income, meaning you have more expenses than income, then the expenses have to carry forward. And it's always depreciation last that's most likely to get carried forward. So squeezed in here is the idea of a business bad debt. This really is a confusing area to taxpayers. I don't know how many times I've been asked, do I get to deduct the cost of someone not paying me, a customer? And the answer is usually no, because they're on a cash basis. So they didn't report any income from that customer until they received it. So there's no way with cash basis accounting that you can have a bad debt, because the idea of bad debt is that you recorded that they owed you money, you recorded it as revenue when they owed it to you, and then when they didn't pay you, you have to adjust. Well, if you never recorded it as income when they owed it to you, therefore you just can't have a deduction for, you need to adjust it. Okay, it does not have to be fully write off, meaning if somebody owes you $3,000 and you're sure that you're only going to get $1,500, you can take a deduction for the other $1,500, assuming that you have accounts receivable and you recorded as revenue already. All right. But the IRS looks at that kind of thing very carefully. You have to have a lot of evidence that you have tried to collect and were not successful. So that's one area that they are very particular about. Casualty losses, remember we talked about casualty losses as an itemized deduction, and we talked about how it has to be in a federally declared disaster area, it has to be over 10% of your AGI, it's reduced by the $100, all that good stuff. That doesn't apply if this happens to a business. So if you have a flood and you lose inventory, or you have some other casualty and it's not covered by insurance, you still have to, if you reimbursed by insurance, you don't have a loss. So it still is part that's not reimbursed by insurance, but it is much more possible to have a casualty loss for business than for personal, like we discussed earlier. Okay, we already mentioned hobby loss. This is just reiterate that idea that if something is a hobby, that has been eliminated. It was in the past available, and so you should still find old information floating out there as to how to treat hobby losses, but they don't exist anymore in 2020. The income has to be included, but your expenses are not allowed. So it's really the worst possible scenario. Now, what about education expenses? What if you go take classes or something as a member, someone that is self-employed, that has their own business and is trying to work on their education for that business? So if it maintains or improves your skills, it's deductible if it meets the express requirements of the law. So for a CPA having to take 80 hours of continuing education every 2 years, that's explicitly in the law. Therefore, that is an education expense and it's deductible. All right. Where you could run into a problem and not be deductible is if it meets the minimum education requirements for employment. So if you go to classes that get you just qualified, not continuing education, but to get you a credential that you, for instance, go to law school to become a lawyer. Technically, going to law school is not deductible as a lawyer. Okay, that's a minimum for being a lawyer. So that's not issue. The other one is if it qualifies you for a new trade or business. All right, so if it makes you if you're a CPA and you go to school to become a plumber, okay, that's a new trade or business and therefore not deductible. All right. Since we're talking about Schedule C, that's a big source of what we call self-employment tax. We came across that when we were talking about 4 AGI deductions in Chapter 4, but we didn't dig into it a whole bunch. We just said it was there. but this is where that comes from. Take your income from the Schedule C, okay, and calculate your self-employment tax on the Schedule SE. It is limited to the first $137,700 for 2020. At least the Social Security part of it, which is the 12.4%. The Medicare part is not limited. And there's an additional Medicare if your total self-employment income goes over $250,000 on a joint return, and $200,000 for every other type of return. $125,000 for married filings separately. Get that thing. And remember that half of it is all that is deductible for AGI on the actual 1040. I want to circle back to calculating the self-employment tax in a minute, but just wrap up with this last slide about the QBI deduction, which is a very important one. This is a 4 AGI deduction. It is not, you don't need to itemize. It goes directly on the return. It is 20% of your qualified business income or your taxable income, whichever is the less. Okay? And qualified business income is stuff that we're talking about here on Schedule C. Basically anything that you report on Schedule B that fits the definition of a business. What you probably may not be is a rental property that we'll talk about later. That, unless rentals are your business and you spend a substantial amount of time on them, they're not going to qualify under the QBI. Okay? Most businesses, this applies to, and as long as your income is below those two thresholds given in that third paragraph there, 326 or 163, it works. You get to take, it starts to phase out, okay, when your income reaches those levels, and what happens is it gets disqualified for certain professions, and the list is in your textbook of those service type professions. And it can also disappear if you don't have W-2 wages. So then what happens is you start, if your income is over these thresholds and you're not one of those professional businesses, then you could still get the full deduction as long as you have enough W-2 wages you pay your employees, or you have enough assets to still allow you to take the full deduction. So you don't have to worry about those extra tests until your income gets higher. Okay, and then you have to look at whether or not your W-2 wages are sufficient to allow this deduction. All right, so it's kind of a convoluted, because it's a deduction after you calculate all your other deductions and subtract them. All right, that's the idea. So, looking at this calculation, this Excel spreadsheet on self-employment tax for a minute, okay? If you only have self-employment earnings, okay, the calculation, you take $55,000, that would come right off of your Schedule C. You multiply that by 0.9235 and then multiply it by 0.153. Nice, simple. That's your self-employment tax you owe, and this is how much of it, or half of it, that is deductible on the 1040. Okay, let's say that you're over the threshold, $165,000 this time. You still multiply by 0.9235 first, okay? But because you're over the threshold, you have to do it in two parts. You take the whole part and you multiply it by 0.02. That's the Medicare part, and get that total. And then you only take up to the total, up to the maximum of 137.7 for 2020, and multiply that by 12.4 or 0.124 to get the Social Security part. Add them two together, and that's your total self-employment tax. There's your half that's deductible for AGI. Now, what if you have earnings other, you have a job and significant self-employment income. So this person has a salary of $75,000, self-employment tax or self-employment income of $90,000 on the Schedule C. So they still do the same thing. They go multiply by 0.9235, but they have to do it in two parts because they together, these two together, are over the threshold of 137.7. So just like before, we take the whole amount times the 0.029 because that's not limited. We don't have the excess Medicare because we're not over 250 or 200,000. Okay? But then we take the threshold, which is 2020, for 2020 is 137.7, and subtract how much the salary. The point is your salary has the Social Security tax already taken out by your employer. So you don't need to pay it again, but you do need to pay on the rest of the self-employment earnings up to the threshold. So you take the threshold minus your salary, multiply that by 0.124, okay, or 12.4%, however you want to think about it. Add those together. That's your total self-employment tax that you must pay, and this is how much of it is deductible for AGI on the tax return.